Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about Lockheed Martin Corporation. Lockheed Martin is a security and aerospace company which engages in research, design, development, manufacture, integration, and sustainment of technology systems, products, and services worldwide. Its areas of concentration includes space and missile systems, electronics, and aeronautics. Lockheed's program base includes F-16, F-22, and F-35 aircrafts, ballistic and other missile systems, C-130 transport, and Titan launch vehicles. Back in 2019, 71% of Lockheed Martin's sales came from the US government. Now that we have a brief understanding of Lockheed's business model, let's fundamentally analyze this company. Today, we will be looking at Lockheed's key ratios, performing a discounted free cash flow DCF analysis to figure out the intrinsic value of Lockheed Martin, and finally do an expected rate of return calculation to see if we were to invest in Lockheed Martin at the current stock price, what kind of return can we expect on this investment? So let's dive in and look at Lockheed Martin Corporation. Hey guys, let's start off by looking at the key ratios. I'm on Morningstar for Lockheed Martin. Under key ratios, looking at the financials, the first item on the list is the revenue. The revenue is the top line of the company. This is the amount of money that the company makes from its sales. It is measured in millions of US dollars. Back in 2010, Lockheed Martin's revenue was about $45.8 billion, and that number has grown to about $60 billion in 2019. We can see that the revenue from 2010 through 2016 stayed fairly consistent, hovering between $45 and $47 billion. And then we saw a jump in 2017, and the revenue has been growing since. For the trailing 12 months, the revenue is about $64 billion. Next is the operating income. The operating income gives us an idea of the amount of money that the company generates from its core business. We can see that back in 2010, Lockheed's operating income was about $3.8 billion, and that number has grown to about $8.3 billion for 2019. For the trailing 12 months, that number is $8.5 billion. So we can see that over the past 10 years, Lockheed Martin's operating income has been trending upwards. After that, looking at the net income. The net income gives us an idea of the amount of money that's left with the company once it has paid for all the expenses, costs, interest, taxes, and so forth. We can see that back in 2010, Lockheed's net income was about $3 billion, and that number has grown to about $6 billion as of 2019. For the trailing 12 months, it's about $6.5 billion. We can see that the net income followed a similar trend as the revenue, where it plateaued out between 2010 and 2015, hovering between $2.5 billion through $3.6 billion. Then we saw a jump in 2016. This could potentially be because of a one-time sale that Lockheed did, which helped it boost its net income. Then we saw a drop in 2017. This was because of the Tax Cuts and Jobs Act that went into place, and Lockheed had to pay a large amount of taxes. We can see that the net income recovered in 2018, and it has been trending upwards ever since. After that, looking at the dividends, we can see that back in 2010, Lockheed paid about $2.64 per share as dividend, and that number has grown to about $9 per share in 2019. For the trailing 12 months, it was about $9.60 per share. We can see that for the past 10 years, Lockheed has been hiking its dividends, which is certainly something that we want to see as shareholders. We want to see companies that are hiking its dividends. That way, we're getting more of our money back as dividends by investing in these companies. Next, looking at the payout ratio. The payout ratio gives us an idea of how much of the company's net income is actually being paid out as dividends. We can see that back in 2010, 36.8% of Lockheed's income was being paid out as dividends. And for the year 2019, it was about 41.8% of Lockheed's income was being paid out as dividends. Given the fact that these dividend payout ratios have mostly hovered between 30 and 60%, we can safely say that such dividend payouts are sustainable in the long run. Next, focusing on the shares outstanding, we can see that back in 2010, Lockheed Martin had about 368 million shares outstanding. And we can see that over the next few years, Lockheed has been buying back its shares, as the share count has now dropped down to about $282 million for the trailing 12 months. This is good news for existing shareholders. We want to see companies buying back its shares because it increases the existing shareholders' ownership within the company. There are two ways in which capital can be returned back to the shareholders. One of them being dividend payouts and the other one being share buybacks. And we can see that Lockheed has been excelling on both fronts. It has been hiking its dividends and buying back its shares. After that, looking at the book value per share. The book value is calculated by subtracting total liabilities from the company's total assets. Back in 2010, Lockheed's book value was about $10.66 per share, and this number has been fluctuating over the years. For the year 2019, it was about $13.85 per share. And for the trailing 12 months, the book value was about $17.70 per share. The fluctuation in book value per share is a result of the change in the company's total assets and total liabilities. So for example, in 2012, when we saw Lockheed's book value drop from $9.11 to $0.12, this could have been because Lockheed's liabilities went up because it may have taken on more debt, which means that book value would go down, as at the end, book value is total assets minus total liabilities. So when the liabilities go up, your book value is going to go down. Similarly, if the assets went down, so for example, if Lockheed said that, hey, some of its assets were impaired, which would have brought down its total assets, then the book value would have dropped as well. So that is what's causing the book value per share to fluctuate over the years. Next, looking at the free cash flow. The free cash flow is what we get when we subtract capital spending from the company's operating cash flow. We can see that back in 2010, Lockheed's free cash flow was about $2.727 billion. And for the year 2019, it was about $5.827 billion. I will be using the past 10 years of free cash flows for my expected rate of return calculation. And I will be using the 2019 figure of $5.827 billion for my DCF, discounted free cash flow analysis. Now let's look at the profitability of the company. First, we'll look at the net margin. The net margin is the ratio of the company's bottom line to its top line. So it compares the net income to the company's revenue. We can see that back in 2010, Lockheed's net margin was about 6.39%, and that number has grown to about 10.42% in 2019. We can see that for the past decade, for the most part, Lockheed's net margin has been trending upwards, except in 2017, back when Lockheed had to pay a significant amount of taxes because of the new Tax Cuts and Jobs Act. Finally, what this 10.42% net margin means is every $100 that Lockheed makes from its sales, by the time it pays for all the expenses, costs, interest, taxes, it has about $10.42 left as pure profit. Next, looking at the return on equity. The return on equity is the ratio of the company's net income to its shareholders' equity. We can see that back in 2010, the return on equity was about 74.67%, and that number has grown to about 275.60%. We can clearly see that Lockheed's return on equity is abnormally high, and this is because its equity portion, which is the book value, is really low because it has large liabilities, which causes equity portion to drop down. So when we divide net income by a small shareholder's equity number, we will be getting a large return on equity number, which is what we are seeing with Lockheed Martin. Next is the return on invested capital. This number gives us an idea of how efficient the management is at allocating capital and getting a return on that investment. We can see that back in 2010, Lockheed Martin's return on invested capital was about 35%, and for the year 2019, it was about 43%. Finally, looking at the interest coverage. The interest coverage is the ratio of the company's income to its interest obligations. Benjamin Graham, the father of value investing, would only prefer to invest in securities that had interest coverage of 5 times or higher. We can see that for the past decade, its interest coverage has always stayed above 5 times. For the trailing 12 months, the interest coverage is at 14.16 times. What this means is Lockheed Martin can pay off its interest obligations 14.16 times using its income. Now let's look at the financial health of the company. We'll start off by looking at the current ratio. The current ratio gives us an idea of the company's current assets to its current liabilities. We want to see companies to have current ratios greater than 1.0. And what this means is the company has enough current assets to fulfill its current liabilities for the next 12 months. Back in 2010, Lockheed Martin's current ratio was about 1.15. And for the next 10 years, its current ratio stayed above a 1.0. For 2019, it was at 1.22. And for the latest quarter, it's 1.33. So this goes to show that Lockheed Martin is liquid enough to survive for another 12 months. Next, looking at the financial leverage, we can see that back in 2010, Lockheed's financial leverage was at 9.46, and that number grew to about 15.20 in 2019. For the latest quarter, its financial leverage was at 10.25. Finally, looking at the debt-to-equity ratio, which compares the company's total debt to its shareholders' equity, we can see that in 2010, Lockheed's debt-to-equity was at 1.35, and that number has grown to about 3.65 in 2019. When we compare Lockheed Martin's financial leverage and debt-to-equity ratio to that of its competitors such as Raytheon, we can see that Lockheed has taken on more debt and is more leveraged than its competitors. Now let's look at the efficiency ratios. The first item on the list is the days sales outstanding. This number gives us an idea of how many days go by from the day Lockheed recognizes its revenue to the day it actually receives cash for its service rendered. We can see that back in 2010, the day sales outstanding was at 47 days, and that number has dropped down to about 14.59 days in 2019. Ideally, we want to see the days sales outstanding number to be steady or declining, and we can see that Lockheed has been on the right track for the most part when we look at the 10-year trend for its days sales outstanding. Next, looking at the days inventory, this number gives us an idea of how many days does Lockheed Martin's product sit in its inventory before it's sold. Ideally, we want this number to be as low as possible because we want to see a company sell its inventory as soon as possible. We can see that from 2010 through 2016, Lockheed's days inventory had been increasing, so it was going in the opposite direction. However, after that, Lockheed's days inventory has dropped down, which is a good sign that it is getting better at selling its inventory. Back in 2010, the inventory number was at 19.83 days, and for the year 2019, it was about 23.47 days. For the trailing 12 months, it's at 22.18 days. What this means is Lockheed Martin's inventory sits in its system for 22.18 days before it's sold. Next, looking at the payables period, this number gives us an idea of how many days does Lockheed Martin take to pay its suppliers. We can see that back in 2010, it was about 15.9 days, and for the trailing 12 months, it's 14.40 days. We can see that the payables period over the past decade has been fairly consistent and steady, and this is something that we want to see. We do not want to see a company that is holding on to its cash in order to play around with its cash flow statements. And finally, looking at the inventory turnover, this number gives us an idea of how many times does Lockheed Martin's inventory go through its system in a calendar year. We can see that back in 2010, its inventory turnover was at 18.40 times, and for 2019, it was about 15.55 times. What this means is in the calendar year 2019, Lockheed Martin's inventory went through its system 15.55 times. Now let's look at the valuation of the company. Over here, we will be comparing the current valuation of Lockheed Martin to that of the S&P 500. The S&P 500 is simply the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. Lockheed Martin's PE ratio is at 15.5, whereas S&P 500 is at 27.2. Next, the price to book value. Lockheed Martin is at 20.4, whereas S&P 500 is at 3.8. Next is the price to sales. Lockheed Martin is at 1.6, whereas S&P 500 is at 2.7. After that, price to cash flow, Lockheed Martin is at 13.0, whereas S&P 500 is at 15.8. And lastly, the dividend yield. Lockheed Martin's dividend yield is 2.7%, whereas S&P 500 is at 1.7%. So we can see that apart from the price to book value ratio, all the other metrics show that Lockheed Martin is undervalued when compared to the S&P 500. Hey guys, now let's look at the discounted free cash flow DCF analysis for Lockheed Martin. Over here, I pasted the 2019 year's free cash flow number, which was $5,827 million. I'm using the annual growth rate of free cash flow to be 3%. What this means is I'm assuming that Lockheed Martin's free cash flow will grow at 3% every year for the next 10 years. I'm using the discount rate to be 10%. What this means is I want the security to yield me a 10% return on my investment. The long-term growth rate, I'm assuming it to be 2%. What this means is after the 10-year mark into perpetuity, I expect Lockheed Martin's free cash flow to grow at 2%. Numbers of shares outstanding, Lockheed Martin has 282 million shares outstanding. Finally, the long-term debt. Lockheed Martin's long-term debt is at $11,404 million. I got this number from Lockheed's balance sheet. And after taking all of these inputs into account, we get the intrinsic value to be $233.89 per share. When we compare this intrinsic value to the current stock price of about $362 per share, we can see that we would be paying a premium of about 1.55 times if we were to purchase the share of Lockheed at the current stock price. And finally, the way we calculate this intrinsic value is we look at what the free cash flows will be every year for the next 10 years. We sum up all those free cash flows. Then we take into account the perpetuity component. In other words, we look at what the free cash flows will be from the 10-year mark into perpetuity. We add up all those free cash flows. And then we get the intrinsic value to be about $77,359 million. Then we subtract the long-term debt from this number and divide by the shares outstanding to get the intrinsic value per share to be about $234. Hey guys, now let's look at the expected rate of return calculation for Lockheed Martin. Over here, I pasted the past 10 years of free cash flows that I got from Morningstar. All the numbers here are in millions of US dollars. This is the yearly free cash flow trend that we get over the years. We can see that for the past decade, the trend has been facing upwards. After that, looking at the future data and predictions, I'm assuming that there's a 25% likelihood that its free cash flow will grow at 5%, a 50% likelihood that Lockheed's free cash flow will grow at 2%, and 25% likelihood that its free cash flow will decline at 3%. This is the potential free cash flow raise that we get into the future after taking into account the numbers of shares outstanding, which is 282 million shares. At the current stock price of about $362 per share, we can expect to get a return of about 4.8%. What this means is if we were to invest in Lockheed Martin at the current stock price of $362 per share, we can expect to get a return of about 4.8% on this investment. Hey guys, now let's wrap it all up. We saw that Lockheed's revenue, operating income, as well as net income for the past decade have been stable and predictable. We saw that Lockheed has been hiking its dividends every year for the past decade, and its payout ratio appears to show that such dividend payouts are sustainable in the long run. We saw that Lockheed's return on equity number was abnormally high. This was because of Lockheed's large liability component, which causes its equity portion to drop down. So when we compare the net income to the equity portion, given that equity is small, we would be getting an inflated return on equity number. We also saw that Lockheed's interest coverage has been greater than 5 times every year for the past decade, which shows that its debt interest obligations aren't getting out of control. After that, when we looked at the financial health of the company, we saw that its current ratio was greater than 1 times, which tells us that Lockheed has enough oxygen in its system to survive for another 12 months. Lockheed's financial leverage and debt-to-equity ratio were on the high end when compared to its competitors. We also noticed that Lockheed for the most part is efficient now than it was 10 years ago. The only downside was that it is less efficient with its inventory now than it was 10 years ago. From a valuation standpoint, we saw that on most of the metrics, Lockheed Martin is undervalued when compared to the S&P 500. When we performed the discounted free cash flow DCF analysis, we saw that the intrinsic value comes out to about $234 per share, and we compare it to the current stock price of $362 per share, we can see that we would be paying a premium of about 1.55 times if we were to purchase the stock at the current stock price. Next, when we looked at the expected rate of return calculation, we saw that we would be getting a return of about 5% if we were to invest in Lockheed Martin at the current stock price of about $362 per share. So after looking at all this information, we can see that Lockheed Martin is fundamentally sound. However, it has a higher leverage and debt-to-equity ratio than its competitors. Given that the current stock price is about 1.55 times higher than the intrinsic value, it does appear to lack the margin of safety that I would like with any investment. At the same time, Lockheed's stock price may go to $500 or $600 per share in the next year or two, but however, it lacks the margin of safety and the return that I would want on my investment. As far as the opportunity costs go, I think there are other investments out there that would provide a greater margin of safety and a higher return on investment than Lockheed Martin. As Warren Buffett says, there are no called strikes in investing, and this is one of the times when I'm going to pass on this investment. Hey guys, that is all I have for you this week. Hopefully you found this video on Lockheed Martin interesting. Please do like, share, comment, and subscribe to my channel. And if you have any recommendations as to which stock I should review next, please leave it in the comment section below. I would greatly appreciate it. Thank you.